I'm Sebastian St. James. In a previous video, one of my viewers asked, an idea for a future video, Sebastian, what is franking? So, what are franking credits and how can you get money back from the government in your tax return? Imagine that you work for The Man Proprietary Limited. The full company tax rate is 30%. The Man earned $100 million, is taxed at a rate of 30%, leaving them with $70 million. They pay you $100,000 minus income tax, which is not really a part of this discussion at all, leaving them with $69.1 million. Except that is not how it works. Taxes are paid on profits. Your wage is an expense to the business and therefore your wage comes out first. So The Man earned $100 million. They paid you $100K, so that comes first, leaving them with $99.9 million. On that, they are taxed 30%, leaving them with $69.93 million. A new law gets voted through Parliament which demands that tax be paid first before employee wages. The Man Proprietary Limited earned $100 million, is taxed at 30%, that's the new rule, remember? Leaving them with $70 million. Now they pay you $100,000, they don't take out any tax this time, but they give you a 30% tax credit, leaving them with $69.1 million. Tax credit? Well, how does this affect you when it comes to your tax return? Johnny Downtrodden earned $100,000 with a 30% tax credit. Remember, that's what the company's already paid in tax. He should be taxed on $100,000 at $22,967. The tax credit is $30,000. Therefore, the tax refund is the amount that's already been paid by the company on that, which is $30,000, minus the amount that he normally would owe, which is $22,967, giving him a tax refund of $7,033. If you understood that example, then you already understand franking credits on dividends because essentially they're the same thing. Here is Pam the pensioner. Pam the pensioner earns $0 outside of the pension. Here is Sam the working man. Sam the working man earns $40,000. Here is Eve the executive. Eve the executive earns $250,000. Pam the pensioner earns $5,000 in dividends. Yippee! Sam earns the same and Eve earns the same. Clearly, they own the same shares. Coming up shortly, I'll have a video discussing the tax advantage of receiving dividends versus selling down some shares and paying capital gains. So make sure you're subscribed so you don't miss out. The imputation system allows franking credits to be passed on. If you see anything about imputation or franking credits, it's all part of the one system. The imputation system was introduced in 1987 by Labour's Treasurer, Paul Keating. Before 1987, an Australian company would pay company tax on its profits at a flat rate of 49%. 49%? Corporate tax now is 30%. How times have changed. And if it paid a dividend, the shareholder was subject to income tax on that dividend. The company and shareholders had an incentive for the taxed income of the company to be retained by the company. Paying a dividend gave rise to double taxation. So the company was first taxed at the corporate tax rate, and then you, with your dividend, got taxed again. Madness. That was then. Let's see how imputation credits work now. The Man earned $100 million, was taxed 30%, pays out $5,000 to Pam the pensioner with a $1,500 franking credit. Pays out the same amount to Sam the working man and Eve the executive. Right, we've received our dividends. We have our franking credits. How do they work at tax time? Pam the pensioner earned $0 outside of the pension, received $5,000 in dividends with a $1,500 franking credit. Now, the pension plus the $5,000 of the dividends is still below the tax-free threshold. $1,500, that's a tax paid already. That's a franking credit. Minus $0, which is the amount that Pam the pensioner should be paying in tax, leaves over $1,500. So, Pam the pensioner submits a tax return and gets back $1,500. So, how does Pam get back $1,500 in cold, hard cash? Well, it's all electronic these days. It goes straight into a bank account, but she, as a pensioner, needs to pay no tax because she's below the tax-free threshold. Now, the company's already paid tax on that dividend, so therefore she needs to get that money back so that that dividend is taxed at her rate, not at the corporate rate. Sam the working man earned $40,000. He received the same dividend. Now, his marginal tax rate is 19%. The amount of tax that he would owe on that dividend would be $5,000 times his marginal tax rate is $950. However, he's already paid $1,500. He only needs to pay $950. Therefore, he submits a tax return and gets back $550. This is a partial refund. He doesn't get the whole amount back, but because his tax rate is at a level that he does not pay 30%, then he does get some of it back. Eve, the executive who earned $250,000, on that dividend at a marginal tax rate of 45%, she would owe $2,250. Now, already she gets credited to her $1,500, but her tax amount is higher than that. In fact, it's $750. So she submits her tax return and then she's required to pay $750 extra in tax. On exactly the same dividend with the same franking credit, it affects different people on different wages differently. Pam got a full refund, Sam got a partial refund, and Eve needed to top up and pay a bit extra tax. What about partially franked versus fully franked? What's the difference? Halvesies Proprietary Limited paid a 50% franked and 50% unfranked dividend of $5,000. Interesting, well, it's getting a bit more complicated, except really, it isn't. Fully franked means that 30% of that dividend has already been paid in tax. Unfranked means none of it has been paid in tax, therefore it's totally up to you. Partially franked means, well, somewhere in the middle, or if you like to think of it, part of it is fully franked, part of it is unfranked. Sam the working man received $2,500 with a $750 franking credit from Halvesies and $2,500 unfranked. It may also appear as $5,000 with partial franking of $750. It means all the same thing. His marginal tax rate is 90%, therefore he owes $950 for that $5,000. Tax he's already paid is $750, that's his franking credits, therefore he still owes $200 in tax, so he submits his tax return and pays $200 extra in tax. There's no need to be confused about partially franked dividends. I have this dividend. How much tax do I have to pay on that? How many credits do I have to offset that amount, right? Are they fully franked? Are they partially franked? Don't care. Give me the dollar amount, subtract the two, and that's how much tax I owe or how much I get back. There is a secret loophole inside the Australian tax system that means you may not have to pay tax. Click here to find out why.